Applied Materials. So Applied Materials provides software services and manufacturing equipment to the semi and display industry. So it's one of those companies that makes the equipment that's needed to be a semi. Let's get to it. So the financial performance, the net income margin has been fairly stable, below industry average of 27%, only slightly though. And the net income margin performance is decent and not that far behind from the industry average. And the margin has been going from strength to strength. So growing margin, all right, I can live with that. Decent cost performance. Costs can be said that are justified. They're not growing at unsustainable rate. The cost that I mean, they're not really growing at unsustainable rate and are resulting in a return. So looking at how much they're spending on cost, it's not really depreciating margin. And this investment in cost, look at what it's doing. It's resulting in a return in the form of growth in my revenue as well as my net income supported by strong growing margin. Right? I can live with that. That's very good. R&D as a percentage of revenue in line with industry average. Industry average is about 13% and we're spending about 30%. So we can live with that. In line, decent. No complaints with that. Like I said, the entity is realizing a return on operational costs as operational costs are resulting in growth in revenue. The revenue is growing at 34% and net income is growing at 53%. That's in 2021. So good performance overall. No one can be happy with that. The return on equity, even though it's below the industry average is about 53%. It has, however, been improving. Slight dip, very slight dip, but it has been overall improving over the past few years. So its performance does show that AM Applied Materials is a company that is very efficient in realizing returns on capital of equity. Right, good, easy, decent, satisfied. No complaints there. Financial position, current ratio has underperformed the industry average at 2.9, but still a decent ratio. The ratio does indicate that Applied Material does have significant current assets to cover current liabilities. So no heightened liquidity risk on the balance sheet. Same with the asset test ratio, underperformed the industry average. Industry average is about 2.17. Uh, but it does have enough liquid assets on hand to cover current liabilities as and when they fall due. So the asset test ratio, same as the current ratio, they both underperform the industry, but at these levels do not highlight an increase in liquidity risk and highlight a pretty stable, a pretty decent liquidity position in AM's balance sheet. So not awful, but both ratios do indicate decent, strong enough liquidity position. Now the decline in the current ratio from 2020 2021 is mainly due to the decline in cash. Cash went from $5.3 billion to $4.9 billion in 2021. But again, nothing really to throw a hissy fit about. Still a liquid balance sheet. Inventory days have overperformed the industry average. Now, on average, the inventory days are about just over 160 days. AM, its average inventory days are 144 days, so it does not hold inventory for longer than the industry average. This is very good. Good asset management and just supports the stable and strong um, liquidity position highlighted by the asset test and the current ratio. So very good, very good. No liquidity risk from my point of view. The balance sheet is liquid enough. I like a liquid balance sheet. All right. Now the debt to equity below the industry average. Industry average is 171%. So the good indicate that as AM is not highly leveraged, There isn't a heightened financial risk on the balance sheet. The balance sheet is pretty attractive. So the high debt levels do make sense. You kind of do it. It is normal in this industry to have high debt levels, but the most important thing is that AM does not have debt levels above the industry. The high debt levels are of course needed as um, revenue, is only received once, the equipment is shipped or has been substantially manufactured. As a result, you will get companies like will get to just plug a shortfall in cash flow. But again, not a heightened risk. Debt levels are normal in relation to the industry average. Now the cash position, the cash from operation margin. Below the industry average is about 26%, but only slightly, but has improved dramatically has improved decently from 2020 to 2021. Uh, there has, however, been an underperformance in relation to the industry. Yes, we do know that the industry is about 26%, and it's only at 23%. But like I said, not to worry, it has been increasing. Does indicate a company in applied materials that has operations that can convert revenue into cash. Strong business model, cash flow positive business model. The sufficiency of cash flow below the industry average, but only slightly. Industry average is about 0.66. Materials at 0.65. So only slightly below the industry average, very, very slightly. Um, the sufficiency of cash flow has been improving, supported by the strong cash margins. So decent, you know, um, very decent. No complaint from my side. The sufficiency of cash flow does indicate that Applied Materials can generate cash flow to fund operations at easy level. It is very good. A lot of cash, however, of Applied Materials does go into rewarding shareholders. Again, it's an efficient use of cash. If there isn't any businesses or any investments needed to be made in the operation, more of an efficient use of cash to just give it a reward to shareholders rather than hoarding it. The PE is slightly below the industry average. The industry average PE is just over 22, close to 23, and Applied Materials is sitting at about 21, it's over 21. So it's a pretty cheap company. So overall, Applied Materials, you know, it has a very cheap PE. It's performing really, really well. I really, really, really like this company. The company that's performing in a very, very, very decent position.